Canadian institutional and retail investors are taking on more private debt, both as a replacement to their equity as well as a tool to enhance their fixed income allocations. But what exactly is private debt, and how can it benefit both the retail and institutional investors alike? As with any asset class, there are benefits and risks associated with investing. And here to unpack all of the details surrounding this often misunderstood asset class is Rob Anton, Managing Director and Partner at Next Edge Capital. And I'm your host, Claire O'Hara with the Globe and Mail, and you're watching Asset TV's Private Debt Masterclass. Thank you all for joining us today, and I'm just going to dive right in. What is private debt?
Simplistically, it is just a privately negotiated loan, that happens typically outside of the traditional banking networks, and that's kind of how I break it down in a very simple format.
Just assets under management towards private debt has grown significantly over the past decade. So why are investors allocating private debt? What's attracting them now?
I think the primary reason is that the opportunities for return amongst traditional fixed income investments has been tough. Challenged due to low interest rate environment, and this has caused many investors to seek alternative forms of making returns, and private lending is one area in which people have kind of gravitated towards. Obviously the fact that they've been able to achieve some attractive returns has helped that cause. I definitely add that the consistent return stream that they've been able to generate, the fact that they tend to have lower levels of volatility, although I think that can be a little bit of a caveat because some of that is masked in the sense that they're not traded vehicles. The fact that they have low levels of correlation to typical stocks and bonds make them a valuable portfolio diversification tool. And I think most private lending managers, first and foremost, their goal is capital preservation. I think that gravitates really well with investors.
Private debt in general offers an attractive risk return potential, especially considering traditional options. So why do you feel the yield rate premium exists?
It's a really good question, Claire, and one that I've spent a lot of time actually researching and studying. So we got into the private lending marketplace, initially as investors, or interested investors looking at capitalizing on an opportunity. Over that time frame, we've now built a fairly large lending business to capitalize on that opportunity. But the first thing that had my spidey senses kind of go up about the industry was, the yields relative to, the risk that you were taking. Was there something that we were missing on the risk side that we just didn't know about that was giving that higher yields? And, we really needed to tackle why that excess premium was happening. And, I think there's a lot of different reasons for it. It varies depending on which area in the private lending marketplace you were at. But definitely the fact that, the 2008, 2009 credit crisis, changing of the regulatory marketplace, deleveraging of the banks, and them making a conscious decision to pull back from lending to certain areas of the marketplace definitely created a void that a lot of non-bank lenders came in to fill. That inefficiency, coupled with the whole inefficiency of a lot of businesses and companies around the world, are now having to find alternative means of financing, which is kind of an inefficiency in itself. They're used to going to the bank, and now they have to find other means, and it's very inefficient. A lot of people don't talk about this, but the actual cost of capital for non-bank lenders is vastly higher than the bank's cost of capital, which is, predominantly, GICs or savings in banks, which is very, very low. So that's a few reasons. We think that you can capture other premiums in the marketplace and kind of navigate our investing style to try and capture as many of these yield premiums as possible. One we think we're picking up is size. Lending to businesses under a certain loan size, we think has less competition, and you can pick up some excess spread. Complexity, of the loan transaction creates less competition and sometimes excess yield. The speed at which the company needs money, you can sometimes charge a higher rate just because you have to get around that very quickly.
Just sticking with the risk conversation, there's a long held belief that higher returns are tethered to higher risk. But in the case of private debt, that's not necessarily true. So can you walk us through the whys?
The amount of companies out there looking for capital is immense. We run across so many different businesses, our focus is in North America, but so many businesses in North America that require, lending capital, a lot of times for growth. And, you can kind of pick and choose your spots as to, what fits kind of your box that you, invest or lend towards. And, like Phil said, it's a negotiation, it's, you might not come to terms on stuff, and a lot of deals do fall apart, after those initial negotiations, because you're looking for more collateral and they're not willing to give it, or they just don't have it. So it's definitely a negotiation process there. We think what's important to, in addition to some of my previous comments as far as why that, excess yield exists, supply demand fundamentals are obviously the biggest, but, we think, we think we can put those odds in our favor through a number of factors. One, in addition to that, is actually origination efforts. We feel that putting a lot of money and capital into origination can actually help us, find more deals which we can be more selective on, which has, we think a knock-on effect to lower default rates, but as well potential premium pickup on loans.
When we're talking about markets maybe not giving the traditional opportunities out there, could an investor swing too far?
I really feel that it really depends on the mandate of the fund, the liquidity in the fund, and how it's kind of sold. I know all of our private lending vehicles are sold by accredited investor, type status. It's not something that's necessarily bought. It's something where we're going out and telling the story. Our client base is varied, but we kind of partner with our client base in the sense that we're very transparent as to what type of loans that we're putting out in the marketplace, the risks that are inherent with that go forward, that sort of thing. So, our client base is a combination of, very successful investment advisors that tend to be portfolio managers, so they're running discretionary on behalf of their clients, some investment counsel firms, family offices, and a handful of, small fund companies. So, as far as educating them on, what they're actually getting into is we feel is just part of the process. We kind of, very much open, to that sort of thing. And, making them aware of where things can go wrong and stuff like that, I think helps create sticky money so that, during the next economic downturn when, companies are making less money and people are making less money and there's less money to go around is typically when, when companies might have less ability to actually pay back their debt. So getting them to understand how we can work through these things, where the security is, that sort of thing, and that it's not just a foolproof way of investing, I think is really important. Regarding asset allocation decisions, I think it really varies. At the core root of private lending is, their fixed income investments. The illiquid nature of private loans is the fact that, it makes it a little bit more tricky. So, depending on who's doing the investing, and you'll probably agree, Phil, but, it's I see it most often allocated to within an alternatives, general alternatives bucket, which is kind of like a catch-all. Some have a carve out for actually a fixed income alternative. Some put it within fixed income with the caveat, of the liquidity portion there. And some actually have a separate carve out for private lending.
So Rob, I'll jump back to you. It's often mentioned that as an investor, factoring is an arbitrage opportunity. So can you explain what's meant by that? Yeah,
for sure. It really attracted us as investors to that space. So factoring is a means of financing, a company through the purchase of their receivables, and it allows that company to advance their cash flow cycle to, in most cases, actually help the company grow, start working on their next purchase order, things like that. The opportunity as an investor is often the receivables that you're purchasing off this company tend to be of a higher credit quality than the company that you're buying them off of. So what you're able to do is purchase, higher credit quality receivables, yet charge a rate more attributable to the lower credit quality company that you're purchasing it off of. So, having spent, a decade and a half in hedge fund land, arbitrage is a fairly large opportunity. When we were looking into this space as an investor, we definitely saw that right away and built an entire business around trying to capture that inefficiency. So,
private debt funds tend to have very low volatility. So maybe you just want to go in a bit more detail on why that is.
It depends on the type of lending, obviously,
Yeah.
you're doing. It's, the valuations, in the private lending world are more based on the actual fundamentals of the actual underlying loan. And because they actually don't trade in a formal marketplace, they're not subject to the market sentiment pricing and, the laws of supply, demand, things like that. It doesn't mean that if you have write-downs on a loan that it's not going to be impacted in the net asset value and add to the volatility of the loan. But you really don't have to worry about the fluctuations from the buy and sell demand. And one good example of that is throughout 2008, if you look at a number of the corporate bond indices versus the corporate defaults that they actually received during that time period, a lot of corporate bond defaults were under 10%, yet their indices were down 35, 40%. So there was absolutely, no reflection or very little reflection to the true underlying value, and they had to deal with the market sentiment pricing. So I think that makes it quite attractive, from a private lending standpoint. What investors really like about it is that you don't have to deal with that fluctuation. Obviously, the flip side is that you don't have a formidable market to trade these in, so you're going to get less liquidity. In good times, we could probably sell a lot of our loan book actually at a premium right now. When the next recession comes, we'll see if there's as many bidders. So you're really planning to, you're coaxing your clients and stuff like that. We do have a fair bit of liquidity in our portfolio, just in the sense that we're on the shorter end of the private lending spectrum. That being said, we can't snap a finger and get liquidity the next day.
So over the last 5 years, there's been a lot of new private debt funds that have been launched. And as more retail investors are starting to look at this as well, how can you differentiate between these funds and what's becoming sort of I wouldn't say crowded, but busier universe?
Obviously, a lot of investors, look at the returns. What I think they should really focus on is what is it that this company's doing that's delivering the returns, and what kind of lending are they actually doing. One key thing that everyone should know is, where do these loans, sit in the capital stack? Are they senior loans or are they junior loans? Are they secured loans? Are they unsecured loans? Those type of questions are quite key in order to understanding the potential risks associated, with those loans. So, outside of that, experience and quality of the credit team, I think is quite important. A bull market, I think, masks quite a bit. So, I personally think there's going to be a large separation during the next economic downturn between, strong, lending companies and funds versus, ones that are weaker. And it'll also create a huge opportunity for stronger lending.
Well, I'm sure investors, when they see when we're talking about markets are down and their rates are still high, they're happy, but they might be a bit skeptical about, where is it coming from, or someone's looking to get into it. They start to ask the questions like how. So it goes back to education.
Although there are a number of lending funds that have popped up post 2008, 2009, there's a lot of credit teams that have been around for 20, 30 years, just not in a retail format. So just because they have maybe not as long a track record doesn't mean they don't have an experienced, skilled team that have navigated through recessions as well. But
it's a good point. So paying attention to the team behind the fund is just as important.
So we obviously like the collateral of the receivables.
When we say quickly, how quick?
Well, our typical, receivables, factoring book is turning over in, 48, 50 days. So that's a fairly liquid transaction. More often than not, a company that we, provide, factoring or purchase the receivables as a means of financing for, are companies that are typically growing, whereby they a lot of times don't have unencumbered assets that they can pledge for an asset-based loan, which tends to be a little bit cheaper. But they do business with a lot of good people, and those people become basically the collateral that we buy off them, the receivables. And more often than not, because they're growing, they're having more purchase orders that they need to start work on, and they need to actually bring that, instead of waiting 30 or 60 days to get paid, from those companies that owe them money for goods and services that they delivered. They can actually, we can turn those deals quite quickly and put that cash, in their company so that they can start work on their next business.
Right. Days, not weeks, right?
Yeah, so we do a combination of factoring, and then we do asset-based lending as well. So it's
great. So Rob, just sticking with you, and we've probably touched upon some of these, but what are the key factors that make a good lending fund or business? Maybe you can recap some of those for us.
Yeah, so the obvious one, obviously, is a good credit and underwriting team. I think that's kind of the first thing that a lot of people focus on. We think that, I mentioned this a little bit earlier, but we think that, the origination team is vastly underappreciated on the street by investors and lending businesses as a whole. We spent a lot of time and effort building a very quality, origination team throughout North America. A number of reasons for that. We want to see as many deals as we possibly can. Obviously they'll screen them and feed through to the system the ones that kind of fit our box. But we feel that by seeing more transaction, it allows us to be more selective in the types of deals that we're funding, even within our own box of factoring and asset-based lending. So that's quite key. I mentioned before, we think that seeing more deals can actually lead to potential premium in yield, just because you're seeing more opportunities. Some that might fit into some of these yield premiums that we've talked about earlier. Yeah. And we think that seeing more deals can lead to lower credit quality. It's which is quite key. A colleague of mine who I've known for about 25 years, the company that he was working for about 25 years ago did a research study, and they tried to figure out what, this was actually related to private equity funds, but they were trying to figure out if there was one definable difference on what led to outperformance of one private equity fund over another. And the only conclusive evidence that they could actually find was actually origination, was actually being invited to the table in the first place, was what they found to be one of that consistent, repetitive things that allowed one private equity firm achieving a better return than the others. We think the same phenomena exists in private lending, and have put a lot of our capital into it to try and take advantage of that.
You're absolutely right.
We probably approve less than 1% of actually what our originators see, but what they actually put through even to the system that anyone sees, probably in the tune of 5 to 7%. One thing I'll add in that theme is, once you put a loan on, it's not like, buy and hold, set it and forget it. Monitoring becomes extremely key in that whole process. Having your own team, look at the financials each month, have calls and meetings with the team, having out, in our case, independent appraisers coming in and reappraising assets, or field auditors coming in and doing a full scrubbing of the company. It becomes very important part of the process. Anything that could lead to early indications of warning signs that can help you tackle a potential problem earlier than later is really key to the process.
I've heard you say accredited investors. Is it still at that for the retail investor? Is that where it lies right now? Has this really opened up to the everyday retail investor at this point?
The liquidity constraints on the underlying loans don't allow them to be. So it's not necessarily that we wish them not to be. But I guess an added risk, and why a lot of us couldn't do that anyways, and offer kind of daily liquidity to fit under certain regulations. Nor could we, just because the underlying doesn't have liquidity, so it wouldn't fit anyways. But the big risk out there, that you didn't mention, in addition to those, is just the fact of liquidity mismatch. Lending funds maybe offering monthly liquidity and having 3-year loans on the books that it would take them a long time to actually receive liquidity. So that's an added thing to people to look at. So.